Good afternoon, dear listeners. We are pleased to welcome our new academic member of Banking and Finance School, Akhlior Ibragimov. He is a coordinator on financial markets operations, and he is going to present you the forecast of financial markets, right?
Yeah, that's right.
Okay. Yeah. Over to you, Akhlior.
Yeah. Hello, ladies and gentlemen, and boys and girls. Are you wondering what is going to happen tomorrow in the market? Are you interested in investing in stock market in general? Boy, we have a news for you. Today we are presenting 2021 US stock market analysis for the first time in the history of MDIS. So we are very pleased to welcome you here in our first chat, in our first review. And yeah, let's jump right into that. Don't waste no time. Yeah.
Okay, let's start.
Let's start. Yeah. 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 We can go to the
presentation.
Presentation. Yeah. Let's share this. Right. Let's start with the first thing is first. Let's start with the disclaimer. Yeah, for this kind of videos with this kind of reviews, stock market reviews, or in some sort of investing in the industry, we are required to have a disclaimer. So let's get over with it, and let's start with the projections already. So trading foreign exchange or any other market on margin carries a high level of risk and may not be suitable for all investors. The possibility exists that you could sustain a loss of some or all of your initial investments. Therefore, you should not invest money that you cannot afford. You should be aware of the risk associated with foreign exchange trading or any other type of trading. This video is not a trading advice or advertising of any other source. All the materials are publicly available in the internet. This video is only for educational purposes. So once we finished with the disclaimer, hardest and most boring part of a presentation, let's start. 2021 US market projection. This is a long-term analysis, guys. For short-term speculators, I'm afraid this is not a suitable. They may not be suitable because the volatility in the market might be vital factor. Yeah, but it's always good to have a long-term picture of a market condition under our table as a background. That will show us the biggest turning points and the swing highs and swing lows. First of all, I want to eliminate the first possible question. Why US stock market? Yeah, why not Chinese market? Why not Singapore market or London market? Why is US stock market? Well, US stock market is a benchmark, the most widest and mostly traded stock market in the world. Yeah, and it's the most correlated to the world economy's stock market. As an example, we can bring 2008 recession, yeah, financial crisis. USA started with a crisis, and the whole world was dragged with it. So US stock, when you want to talk about the stock market, you talk about USA first. So that's why our choice was USA as a default, if I may say. Yeah. So projection for S&P 500. So S&P 500 is the sum of a 500 biggest blue chips or leading companies in the US stock exchange. Yeah, and this is a benchmark for the whole stock market of USA. Sometimes investors call it the breath of an economy. So because the biggest blue chips, leading companies are gathered into one benchmark, S&P 500, speaks for itself. So yeah, we will be looking at S&P 500 a lot in this conversation because this is as I said, breath of an economy. So in front of you, you have a snapshot from January 3rd. This is a oh, I forgot to make it bigger. Yeah. So this is are we sharing the right one? Yeah. Okay. So the snapshot in front of you is the S&P 500 in the 3rd of January. As you can see, it's published in TradingView, and our internal sources and all the related sources in the internet. Yeah, we have projected that S&P 500 is going to make a last push upside to the upside, and it's going to make a big move to the down. So the downside risk is big, and today, if you're interested and if you read about the stock market, everyone out there is thinking that 2021 is going to be the best year for the stock market. Yeah, this is going to be the next bull market. Well, here in this side of a pond, I'm not convinced that this is the most possible scenario. I think 2021 is going to be volatile, and it is going to have a downside risk in a big portion. So let's start with the live charts. Yeah, like where is our live charts? Hold on. Let me see my browser. Yeah, this one. Here we go. There we go. Yeah. So as I said, on the 3rd of January, where the arrow is, yeah, right over here, we have projected that stock market is going to make a last push to the upside. And the area of, we have mentioned this, we have colored this in the yellow. This is going to be the zone of supply and demand, as it's called, yeah? This is the zone where it decides where to go. I think, personally, if you ask me, I think this is going to be a turning point. And it's not, of course, in the market, there is no 100% probability, but we can look for the reversal pattern in this area right here. So far, the projection, our projection is working well if you compare it with the publication we have made on 3rd of January. Let's delete this arrow, otherwise it's, yeah, here it is. And the reasoning why I think the stock market is going to go down is going to be clear when I finish my presentation in PowerPoint. I'll show you all the data and all my reasoning in there. But before that, I want to take your attention a little bit to the whole picture of 2020. How was this year? Yes, in the black line, I have colored the start of a year, and end is around right here. Yes, we have just started the year. How was this year in terms of market condition? Well, I think they would not be surprising if I say this year was very, very uncertain, very volatile, and this year followed by amazing downsides and upsides. With the starting with the mid-February, we had a very big meltdown caused by COVID-19 restrictions, quarantine measures taken by USA. Yeah, and dipping it 23rd of March. this was a turning point where stock markets start to reverse. First of all, why did it reverse? When they saw the stock market meltdown and projected GDP decrease was a whopping 32%, US policymakers started to print money. Federal Reserve, as it calls, the acting central bank of USA, started issuing cash, started to printing cash and giving it to companies and to public, which has created a liquidity in the market and demand for US stocks. So with the simple words, people had money to buy a stock. And that was a simple but very effective move from a Fed. And during the next 9 or 9.5 months, we have seen 7 times record highs. Yes, 7 record highs. And everyone started to scream that US stock market is back on track. US stock market had recovered, but hold on, but not that fast. So let me show you why. Yeah, let's get back on our presentation. Is it our presentation? Okay, this is right. Hold on. Yeah, we'll get back to our. Is it full screen? No, it isn't. Sorry guys, I'm having a hard time with the high tech. Yeah, not a high tech guy. So just bear with me. Just bear with me. I might be a stock guy, but I'm not a high tech guy. Resume slide, yo. Is it? Is it sliding full screen? Is it? Yes. Okay, great. Let's continue here. So this is the, let's look at the main thing. This is the biggest economic data, which is called gross domestic product. You know that, right? This is the GDP, the famous GDP. Yeah, everyone looked up to the GDP. Everyone is working for increasing a GDP, and we'll start with this. If we take a look in the start of at the start of a year, the GDP slammed down 30-something percent, 32%, and it increased after quarantine measures canceled, and it started restart the economy has launched. The economy snapped up back, and then we've seen again the slapping down, and again this. Well, if we look at the average, yeah, the economy is flat in the best case. In the best case, it's flat. So okay, let's continue. I'm sorry, I had to say something. So in the best shape, best word would be the economy is flat. As I said before, as we watched before, the U.S. stock market is making new highs. In fact, it made 7 times a record high. Well, whilst an economy is flat, stock market is rising. That's kind of suspicious already, right? And the next data is called US initial jobless claims. Initial jobless claims, it means this is a number of people who are applying for unemployment for the first time. So if you will, you understand this way, newly people who have just lost their jobs, this is a number of them. Yeah. So if the person has been jobless several months, and it did apply for unemployment several times, this number doesn't include. This is the number of people who are applying for unemployment for the first time. So before the pandemic crisis, before the pandemic, the numbers were around 80,000 and 100,000 people every week. Yeah, nationwide, across America, it's not a it's a healthy economy. It happens. Yeah, you will have a little bit of number of it. But when the quarantine measures kicked in, we can see that the number started to shoot to the 6 digits, even 7 digits, because this number is in thousands. So in the first week, 3.5 something million people lost their jobs. In the second week, it's basically 7 million, and these are the new people. It's coming to the tens of millions of people lost their jobs. And even now, when everybody is screaming that U.S. economy came back, U.S. economy recovered, we can see that the numbers like still reaching a million, nearly a million. So it was like last time I was like 800,000 something people. So that means every week nearly a million Americans are losing their jobs. But because of the Fed printing money and giving up people money every week, $600 a week, $1,000 a week, this is not that visible, and the buying power is not decreasing. But as soon as the aid will end, this is going to give an effect. And overall, this number is not simple number, right? It's quite scary. So the next data is this chart shows the amount of money printed by a Federal Reserve as an injection to the economy. M2 money stock, it's called, yeah. So it's published every 3 months. This data is published every 3 months. It's not everyday data, but last time data was in January 2nd. Here it is, yeah, we can clearly see that. And in January 2nd, the data showed basically $19.2 trillion injected into the economy overall, yeah. Now, take a look at year 2000. This is the year when dot-com crash happened, yeah? IT company crash, which melted down whole stock market. Smooth money printing, nothing dramatic happens in this. Well, something pops up, some billions, some 10 billions, 20 billions, but nothing significant. Take a look at year 2008. It's a great financial crisis. Everywhere it was, the whole economy was going haywire, but Federal Reserve is quiet. They have printed overall like $200 billion or something like that. Compared to U.S. economy, it's just nothing. Yeah, and this data continued to be smooth and in one track. Yeah, as the economy grows, they're growing the amount of money in the surplus. Yeah, it's nothing dramatic. But if you look at the year 2000, they have printed overall basically $3.4 trillion as an aid to the economy. But they said rescue bill, pandemic relief bill. But at the end of the day, all the money people and companies receive, this is a loan, especially companies. That money which they have received from a government goes to their balance sheet as a long-term debt, which sometimes might be detonating their operations, as we will be reviewing in the next slide. So this is the Boeing Corporation. Yeah, this is one of the leading companies in the industrial sector of United States of America. Yeah, you can see the part of their balance sheet. Here with the red line, I have underlined their debt, amount of their debt. In the start of 2020, the debt of Boeing was around a little bit less than $20 billion. By the end of 9th month of 2020, their debt was $57.3 billion. It's nearly 3 times jump. People who are familiar with the accounting or financial management, they will know how devastating it might be. Yeah, especially with this amount of money printing, the inflation might kick in. It will, with a simple theory. In theory, it must come, the inflation, and bringing the pressure to the companies. Pressure will be in the form of their assets will lose value, their earnings per share will lose value, and the second pressure is debt. Yeah, one pressure might be inflation. Second pressure will be debt, right? Let's see the next company. This is American Airlines. This is an example from a tourism and leisure industry. Yeah, in the start of a year, as you can see, 31st of December, they have reported that their debt was a little bit shy from $22 billion. Yeah, by the end of 9th month, their debt increased like $8.5 billion. $8.5 billion for tourism industry. This is a massive amount of money. As a second factor pressing to the companies and to company stocks and their balance sheet after inflation is a debt. Let's move on. That's a Home Depot. Home Depot is one of the most famous retailers in USA. Yeah, this is an example of a retail industry in USA. So their long-term debt was around $27.5 billion in the start of a year. At the end of by the end of a 9th month, it was around $3 billion jump, a little bit less than $3 billion jump. For retailer, is it a $3 billion is big jump again. The debt increase is going to the billions, not even hundreds of millions, but billions. Even retailers are getting a $3 billion debt, yeah? So the next example is General Motors. Dear General Motors, yeah? The famous for everyone. And General Motors actually is quite diversified and massive company which has factories all over the globe. They have a very diversified product, starting from trucks, ending with the electric cars and that sort of transportation. Yes, and the bikes as well. And for them to be in trouble, for them to have a increased debt, that means something is different, something is difficult happening in the economy. Look at this chart. At the end of 12 months of 2019, well, in other words, in the start of 2020, yeah, their debt was, well, around $66 billion. And now we look at the end of 9th month, they had a little bit less than $82 billion. This kind of jump is not normal for the company. The healthy company doesn't make this kind of jump in their debt, in their balance sheet. Yeah, so this tells that how much companies got into trouble because of this pandemic crisis, and it's still to saying it's gone just would be incorrect, considering this kind of jump in their debt of balance sheet. Yeah. The next factor is third. The biggest factor is tax policy change. This is a snapshot from a Bloomberg Wall Street Week. Yeah, this guy, I think everyone knows him. This is the president-elect, 46th president of United States of America, Joe Biden, and he is very famous in corporate world with his tax plan. Yeah, let's see what is he proposing. He's proposing a tax hike from for every single corner of an economy. Of course, his tax program is very big, very boring report. Of course, I have gone through them, and this was the best I could come up with in terms of implementing it, making it simple and rugged to the chart, so the people would understand exactly what's happening. So, Biden tax proposal versus Trump. The red bars are Trump tax policy, which is working currently, and the blue bars are Biden's tax proposal. So that means what's going to happen and what is now going on. Yeah. So corporate tax is going to be increased by 7%. Income payroll tax is going to go from 37% to a whopping 52%. Income payroll tax, that means a salary tax. Can you imagine a salary tax to 52%? Yeah, of course, he is like dividing people into several groups. The people who are earning less, they're going to pay less tax, but people who are earning more than $400,000 a year are going to have a tax increase. At the end of the day, $400,000 a year, this is the earnings of a middle class American, basically middle class American. But of course, we can see that the tax hike is tax hike. Yeah, it doesn't matter whoever it is. Tax increase is never good for the economy, especially after this kind of quarantine situation. Small business tax is going to be increased by 10%. Capital gain dividend tax. This is the most interesting part. Yeah, this is the tax for the investors for their dividend. For example, I have a tax. I have a stocks of Apple. Let's say, yeah, I'm receiving, for example, $1 million as a dividend. That means with the Biden's tax proposal, I'm going to have to be paying 80% more than I'm paying right now. So for foreign investors, this is not going to be good, and many of foreign investors are going to be leaving, because now the tax hike is not for 1 or 2%. The Biden is aiming for Wall Street investors and brokers very much. So he's going to be increasing the dividend tax exponentially, and many of the foreign investors are going to be leaving. So let's sum up. There are three pressuring factors for the stocks. Yeah, three pressures to the stock. First is the probability of inflation, which is going to be brought by this might be a side effect of a money printing. Yeah. Second factor is corporate debt. Corporate debt might be very crucial, very detonating for companies' balance sheet. Yeah. Third, and the most important, is the tax hikes in the near future. Of course, you might say that, oh, Biden is not going to, hike the taxes right away. He's going to take his time. He's going to wait until the economy is fully recovered. Well, let me tell you something. The only news that Trump is going to be reforming taxes, decreasing taxes, had created 2 years bull market. So only the news, only the revision of a proposal of tax program, tax increasing program might bring very big movement in the market. Yes, so let's move on. Now, this is very little bit of complicated chart. So just bear with me. I will walk you through with it. The blue line is the price of S&P 500. This is the price action of S&P 500. Yeah, this is just a line chart of S&P 500. You remember what? I hope you remember what S&P 500 is, right? This is a summarized benchmark of 500 blue chip companies in the U.S. stock exchange. It's the blue line. The red line is margin debt accounts inverted. One more time. Margin debt accounts inverted. What is the margin debt account? If I go now to the brokerage company or the bank, 90% of the time it's a brokerage company, and say, okay, give me a loan to your account, I'll open an account, just give me a loan. Yeah, leverage my account. Yeah, brokerage company leverages my account with the big funds. Yeah, and I buy stocks or indices. Mostly it's stocks. Yeah, it's the most popular thing in America. This is my account is going to be called margin debt account. An account which is created, which is loaded with a debt. All my assets are bought for loan. That's a margin debt account. And the red line is the amount of margin debt accounts inverted. Why do we need to invert this? Yeah. First of all, when it's inverted and compared to the correct price of S&P 500, it shows a divergence. And the divergence serves us as one of the signals of recessions. Look at the gray lines. Yeah, when it diverged from each other, two lines diverged from each other. The tech.com crash of 2000 happened, and the second time when they diverged from each other, the hardest point, 2008, a financial crisis happened. And now look at the current situation. Actually, this is the most diverged situation in the history of this formula. Thanks to the Advisor Perspective website providing us with this information, but look, this is very, very clear that they are diverged. They are diverged very widely. Yeah, and let's move on to the next equation. Now, this chart is much simpler to understand. This is the ratio or the difference between commodity price and the S&P 500. In other words, this is the index ratio, the difference between commodity price and the stock prices, because S&P 500 is the benchmark of 500 blue chip companies in the USA. Yeah, and when this chart shows a very, very interesting information. When there is an extreme high or extreme low, every time when it happens, the recession of the market follows quickly, catches up very quickly. Look at the oil crisis and 73 and 74. I will tell you a little bit interesting information about this crisis. This crisis is the one which made a massive hole on the budget of USSR, Soviet Union. Yeah, eventually because of that, this oil crisis, USSR had collapsed. So just before that oil crisis, our formula, the ratio between the commodity prices and stock prices, made a very extreme high. Yeah, commodity prices were very, very high, pressing the margin for stocks to make a product. For example, cosmetics companies weren't able to charge their clients more money, but their raw materials were rising and rising a lot. So it devastated. There was a devastation of a balance sheet of many companies because the profit margin was getting thinner and very, very thinner. So the next was an extreme high again in 1990. That was due to a Gulf War of 1990. You know that the older ones may know that. In this period, because of a war in Middle East, again, the commodity prices had risen very, very exponentially and very fast, again, pressing to the profit margin of a company. And again, eventually everything calmed down. The peace came, sort of a peace came to the Middle East, and our equation was going back and forth. And in 2000, in 2000, the price of commodities versus to S&P 500, well, in other words, to stocks, was too low. That means the companies were bubbled very, very much against the commodity, and because it happened because of the digitalization. They thought we can digitalize the raw materials. They thought we can do without them. Well, that wasn't the case, and the dot-com crash catched out very quick. So I apologize. I'm going to get a sip of water. Otherwise I can't do with it. So let's continue. And then the next extreme high was in 2008. Of course, we know our dear 2008, which brought us the great financial crisis. Yeah. Okay, and some of the companies have recovered, some of them didn't, but the overall economy, global economy, had recovered, and our equation again was going back and forth, and now it's making a not an extreme low, it's making a record low. That's the lowest point in the history, actually. This is the lowest point in the history. Look, I'm not saying that the recession or crisis is going to happen tomorrow. The terrible is inevitable. It's coming. No, I just want to inform everyone that to be careful, just to keep your cash diversified, keep your accounts diversified, invest, don't keep in cash. Yeah, because this kind of data, this kind of information is very hard to deny, honestly. So it's another pattern in the economy. 2008 1929, 73, 74, Gulf War 1990, 2000, 2008. This is just a pattern going back and forth, and it will go back and forth. It will happen. Recessions and meltdowns will happen. Our job is just to be cautious and to make money if we can. Yeah. So next is this guy. Does anyone know who is this guy? I think there is no person here who doesn't know this guy. This is Warren Buffett. This is the iconic person. He is an icon for investing and capitalism as a whole. Yeah. Over the years, this person Warren Buffett had created his own formula, how to analyze the market. They call it the Buffett indicator. This is a very simple, but at the same time, very, very smart formula to calculate the Buffett indicator. Yeah, we just have to take a total market capitalization and divide it to the GDP of that country. It's as simple as that. Of course, if you're going to get more specific, you can add the total assets of Federal Reserve or the central bank. But the main formula is total market capitalization divided to GDP. Currently, we are sitting in 190.5%. 190.5%. Let's see what it means. So, when we have a ratio less or equal to 73%, the market is undervalued, significantly undervalued. This is the best spot to buy. When the ratio is between 73% and 94%, it's modestly undervalued. Yeah, this is not bad as well for buying opportunities, as a buying opportunity. When the ratio is between 94% and 115%, it's called the fair value. This is the target where all the policymakers and politicians are trying to reach when the stock market and economy is aligned into the one spot. Yeah. But when the market is between 115% and 136%, it's modestly overvalued. That means that we can be scared for a little bit. It's getting slippery. Yeah, sort of. But when the ratio is over 136%, yeah, the market is significantly overvalued. Well, according to the data which is published today, as of today, yeah, we are on 190.5%. We are flying on the skies according to this formula, yeah. So this is very significant because this formula, the Buffett indicator, had proven itself over and over and over again. In fact, how Warren Buffett got rich that fast because of this formula. In 2008, he was managed to sell his stocks very high. He saw that market is overvalued, and he sold his stocks. That was at the time that was very expensive. When the recession happened, yeah, he saw when it's undervalued and bought it back. With this, he made tens of billion dollars, and that's why when we look at this chart, we are not making a mistake. Yeah, we have to consider this stock as one of the main factors of the market, one of the main analytical tools for the market. So let me get back to where's my chart? Yes, here it is. Yeah, it is. Is it? Yes, it is. Okay, so far you can see I'll go for a little bit smaller time frame, so it would be visible more. Yeah. So far, our analysis are being right point to point. Yeah, we are right, like exactly how we have predicted. Yeah. Now, what follows next is we have to look for the reversal pattern in this area. It may happen, it may not happen. We may review our analysis, but for now, this is the most probable place. This is the most important level. It's called the supply and demand area. Yes. For now, I'm holding on to this level. My analysis is working out very well, as you can see. Yeah. So we are waiting, and we are waiting for the confirmation of our analysis. Yeah. So I think this is it for today, guys, and I'm very happy to be in MDIS, and I will be very happy to know every single one of you, each one of you, and if you have any questions, just write in the comment below. Where is it? Here or here? Comment below. Smash that like button and press that bell icon so you will be notified as soon as we make a video. For those who are the MDIS students, I will be in the campus from 9 to 6. Our new building is not ready yet, so I will be joining your dear teachers in 101. So I will be very happy to see you. Yeah, for those who are not MDIS students, you just write me your questions under the comment below. So this is it for now. Be safe, wear your mask, and do your social distancing.
Thank you very much, Ahlior, for today's presentation. It was very informative. I'm very happy that you touched such areas as quantitative easing policy. Yeah. You looked at ratios, right, and went through the analysis of major companies. I was writing something while I was listening to you. And yes, please, students, if you have further questions, we are all here. We have started our financial lab, financial laboratory, and Ahlior Ibragimov is the coordinator on financial markets operations. So that's just like a little surprise to our students, to those in any areas. So even if you are not related to finance areas, please join us. We will create a group, right? Yes, and it's just only the start. There will be series of such webinars, live stream webinars in the future, and we will focus on Asian markets, right? Yeah, of course. European markets. So that's just only the beginning. And thank you very much for joining us. Right? Thank you very much. Yeah, please.
So, and yes, so sorry for butting in. So another comment from the marketing department. Thank you very much for attending. And if you have any suggestions for the further topics, for another format maybe, right? So like that would be a bit more suitable for the students, like rather than online or offline, right? So please contact us in Instagram direct so that we could just send all your commands and requests directly to the executors, right? Yeah. So, and once again, thank you very much. And thank you to the IT department, right?
Yeah, good job, right?
Yeah, very big shout out to them for making this event happen. And I think we will be bothering them quite a lot actually, because this is a sequence video, Avror. Yeah. So very big shout out to them, amazing guys. So if you have any questions, guys, just come and visit me, yeah, to the building. I will be, for now, I will be in 101, or if you're in a YouTube, go to our channel and write it in the comment section right here somewhere. Yeah. So yeah, just be safe there and wear your masks, do your social distancing, and peace out. Over.